Most of you here on YouTube know me as a REIT analyst. That's my specialty and it's what I mostly cover here on YouTube. I'm also very bullish on REITs today because they are priced at their lowest valuations in many years and they essentially allow you to buy real estate that's professionally managed at a steep discount to its fair value. However, that does not mean that I'm only invested in REITs. Diversification is the only free lunch and you never want to be fully exposed to a single sector that could become the victim of a black swan. For this reason, I invest today about 50% of my portfolio in REITs and the other 50% in regular stocks and bonds. And today my biggest stock investment is a company called Patria Investments. I have already covered it on my YouTube channel in the past, but I want to give you an update today because I've been accumulating a lot more of it lately. Hey everyone, this is Yulshi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss my #1 biggest dividend stock investment for the second half of 2024. But before I get into it, I wanted to let you know that I just recently launched a Substack for my REIT newsletter, High Yield Landlord. I'm posting a lot of free research there on some of my favorite REIT investment opportunities. I'll put a link to it in the description of this video. And if you want to take your REIT investing to the next level, we're also offering a 2-week free trial and a $100 discount to the first 100 people to subscribe. This will give you immediate access to my entire portfolio as well as all my trade alerts in real time. So let's start here with some basics. Patria Investments, ticker symbol PAX. This is an asset management company. If you're not familiar with these companies, they're in the business of providing investment services in exchange of fees. And I really like these businesses because they essentially allow you to participate in the returns of a given asset without having to invest your own capital. You participate in the returns by generating fees for managing the investments for others. But not all asset management companies are created equal. The profitability of these companies really dependent on two things. The first one is their ability to grow their assets under management. So what is meant here is their ability to convince other investors to invest with them. And the second one is their pricing power in terms of their fees. And from this perspective, I really like asset management companies that focus on alternative assets like private equity, infrastructure, credit, commercial real estate, and so on because of two key reasons. The first reason is that there is today rapidly growing demand for these type of investments from institutional investors because they have realized that they can improve the risk reward of their portfolios by including alternative assets to their portfolio of stocks and bonds. Being simply invested to the financial market leads to significant volatility and they can reduce that and also improve their returns by including things like private equity, credit, venture capital, commercial real estate, infrastructure, and so on. It's to the point that Brookfield is now predicting that the allocations of institutional investors will shift heavily in favor of alternative assets of the coming years. Today, they're at about 30% of their portfolio. They think they could reach up to 60% by the end of this decade. This represents trillions of additional capital that will be going into these investment sectors. And I think that this is a great opportunity for the leading alternative asset managers like Patria. Taking just a quick break to show you my dog who came to say hi. But the second reason why I really like alternative asset managers is that they enjoy strong pricing power. Typically, investors are willing to pay high fees to invest with the leading alternative asset managers that have strong track records, great reputations. They're willing to pay this premium, and in many cases, it's worth it rather than invest with a small alternative asset manager because they'll be a lot riskier. The outcome of your investment would be less predictable. And if you now compare also the fees that they're able to charge compared to ETF providers like BlackRock, those have close to no pricing power because there's much less skill needed to offer such type of investment vehicle. And so I really like the pricing power of alternative asset managers. And a great example of a successful company in this space is called Blackstone. It's the biggest alternative asset manager in the world. It controls over $1 trillion of capital, and it's been a very successful and rewarding investment to the shareholders who bought in early in the company and then saw its assets under management grow over time. But unfortunately today, for investors who are late to the party, most of these companies are quite expensive. I invested a couple of years ago in KKR, which is another big alternative asset management company. It has doubled in value since then. I also invested in another company called Blue Owl, which specializes in private credit investments. It has also nearly doubled in value. But there is a third company, and this is Patria. And interestingly, despite growing at a rapid pace, it has seen its share price stagnate or even slightly decline in the coming years. I'll put a chart chart on the screen where you'll see that the company has been able to grow its fee-related earnings on a per share basis by 21% per year since going public. So clearly this is not a company that's suffering. On the contrary, it's doing really well. I would also add that the company has very little debt, so it's not selling off because of fears related to the surge in interest rate. The management is actually predicting the company to be debt-free by the end of this year. I ran out of battery on my camera, so I'll continue here on my phone, but I was saying there that the company has been growing its cash flow at a rapid pace. It has barely any debt. So the declining share price is not because the company is suffering or facing any severe headwinds or anything like that. On the contrary, it's doing really well. And because it has still seen its share price decline, its valuation has now dropped to the lowest level ever since the company went public. Today, if you look at its current share price of $12.50 per share and you compare that to its fee-related income that it's predicting to earn in 2025, that will price the company at 9 times its forward FRE, as we call it, fee-related income. But it's actually even cheaper than that because the company has accumulated a lot of net accrued investment performance fees over the years that have not yet been realized. It's about $3.40. So if you now deduct that from its share price, it's actually priced at closer to 7 times its fee-related income on a per share basis today, which is an incredibly low valuation for an alternative asset manager of this quality that has been able to grow at such rapid rate and doesn't even have much debt on its balance sheet. So why is it so cheap then? And I think that it boils down to the fact that Patria focuses on Latin American markets, which are today out of favor. Unlike Blackstone and KKR, which are mostly invested in the US, Patria focuses on Latin American markets. So it's a specialist in alternative investments like private equity, commercial real estate, credit, public equities, infrastructure, and so on in Latin American markets like Brazil and Colombia. And the market sees this as a significant risk, and I agree that these markets are riskier than the US or Europe. However, I still see it as an advantage actually from the perspective of the business, because these are markets that are expected to enjoy significant growth and significant demand from investors over the coming decade because of many trends. The first one that comes to my mind here is nearshoring. Now, increasingly many companies are bringing back portions of their supply chains or even the entire supply chains closer to their end consumer. So think of American companies now bringing back manufacturing plants to Mexico or even a bit further south to Brazil, away from China and Russia, which are dictatorships, and perhaps we've learned now over the past few years that they cannot be trusted as much as we might have thought in the past. So I alluded to that already here, but the growing geopolitical tensions also are benefiting Latin American markets because now increasingly many investors see China as being unreliable. And so if you want to invest in emerging markets, instead of going to Asia or to Eastern Europe, now you're more likely to go to Latin America. And so this is leading to growing asset allocations from institutional investors to this region of the world, which benefits obviously a company like Patria. And then the final reason why I think that allocations are going to grow in this specific region of the world is because valuations remain very low, and it's very much of an untapped opportunity still today, because most investors, again, they've been focusing primarily on their home country or the developed markets, perhaps Asia for emerging markets, but now Latin America is expected to replace Asia to a certain extent in the portfolios of investors, especially as we face growing geopolitical risks. And this is not just a wild theory from me, because it's already been happening. Patria has managed to grow its assets under management by about 40% annually since going public. And I'm simply predicting that this rapid growth will continue going forward because the company remains relatively small in size. It has only about 34 billion of assets under management compared to over $1 trillion for Blackstone. So it's about 30 times smaller in size, yet it's the leader in this big region of the world that's experiencing now rapid demand. You know, it's the leader. It used to be even called the Blackstone of Latin America for a long time because Blackstone used to own a stake in Patria, and it also used to closely collaborate with them. They have an amazing track record. I'll put on the screen the performance of their different products, ranging from private equity to infrastructure, credit, commercial real estate, and so on. And you'll see that they've beaten most of their benchmarks. I'll also put a separate chart where you'll see the performance of its private equity funds relative to benchmarks, since that's where it has most of its capital today. And you'll see that it has done really well. And so understandably, it also has a very good reputation. And so I think it's very likely that investors will keep allocating more capital towards Latin America over the coming years. And Patria, being the leader with a great reputation and many great products, will be able to capture the lion's share of this growth. And the final point I want to make here is that something that's quite interesting actually to REIT investors, so to my audience here on this channel, is that Patria has recently acquired 2 REIT asset managers. And it has also closed a major deal with the biggest bank of Colombia to start a REIT asset management business in a JV with them. And so they're really following the footsteps of Blackstone. You know, the single biggest business of Blackstone that earns it the most fees is the management of its public unlisted REIT, which we call BREIT. It's really big in size with about 100 billion of assets under management. Patria is now going the same route, and it's actually now already become the biggest REIT asset management firm in Brazil following these recent acquisitions. And I think that this is going to actually accelerate its growth going forward, and yet the company's share price has not yet reflected that. So in short, here we have a company that's in a great sector. It has a market leading position. It has some moats in that, you know, investors are much more likely to work with a company like Patria rather than smaller alternative asset managers. It has almost no debt on its balance sheet. It has an amazing track record, having managed to grow its cash flow on a per share basis by about 21% annually since going public. Everything indicates that this rapid growth is going to continue, and yet today it's priced at about 7 times its fee-related earnings if you adjust for the net unrealized performance fees that it has already earned but not yet realized. I just don't know many companies that are priced at such a low multiple and able to grow at such a rapid rate. And this explains why I've been accumulating so much more Patria lately. And it's become really one of my biggest investments in my entire portfolio, even bigger than some of my big REIT investments like Crown Castle, BSR REIT, Essential Properties Realty Trust. It's become an even larger investment. And so I just think that's incredibly cheap and likely won't remain like this forever. You know, I mentioned earlier that KKR and Blue Owl were relatively cheap alternative asset management companies also 1 or 2 years ago for a brief period, but since then they've about doubled in value. And I think that Patria missed out on this rally because it's focusing on Latin American markets, but as the market sentiment for these markets continues to improve and Patria keeps proving the market wrong, its valuation is also eventually going to reflect that, and it's going to close the discount relative to its peer groups, and this could lead to very significant upside. I wouldn't be surprised if the share price of the company appreciates about 50 to 100% from here. And the cool thing here also is that while you wait, you're earning significant dividend income, because this is a capital light business, meaning that Patria doesn't need to retain its cash flow to reinvest in growth. This growth will happen without having to close any major investments, and so it's able to distribute most of its cash flow in the form of dividends to shareholders. Patria today has the same dividend policy as Blackstone, which is to distribute about 85% of its fee related income in the form of dividends to shareholders. This is based on our forward outlook of its earnings in 2025. We expect this to result in about an 8% dividend yield, which again, very significant. How many companies do you know that offer such a high yield, such significant upside potential with this level of safety and growth as well? I just don't know many, and this is why I've been buying so much Patria lately. But obviously this is not financial advice. Do your own research. If you want to learn more about this opportunity, we have an exclusive investment thesis available at High Yield Landlord. We also have management interviews there for you. I'll put a link to it in the description of this video. You would need to sign up for the 2-week free trial to access them, but you won't be charged anything in the first 14 days. If you cancel during those times, you won't be charged a penny. Finally, if you thought that this video was valuable, please click the like button, subscribe to the channel. Sorry for the poor quality, the battery of my camera ran out and I'm traveling at the moment. I'm here in Finland, in my home country, for a little bit by the lake. Thank you very much for your support, and see you at my next one.